One thing a trader has to overcome is to survive the pullback to become a successful trader and a profitable trader. So in this video, I'm going to show you how many types of pullbacks you have to survive and how. Basically, there are two types of pullbacks that you have to survive. First is the current pullback. That means you want to enter a trade when the setup comes. And then when you enter the trade, you have to survive the next pushes up to 3 pushes. And then the second survival of the pullback is the falling pullback. After the market goes your way and then it's gonna pull back again, so you want to survive that to make more profit. Let's take this chart for example. After 9:30 open, the market goes up with consecutive bull bars breaking out, and then when we see this doji bull bar and big tail at the bottom, you can treat this as the pullback. And then at the same time, it's going upward, so you can take this as a signal bar as well. After you enter the market, then here comes the thing. How can you survive the pullback next? Because the market could go down for the second time and the third time before it takes off. So that's the pullback you need to survive for the current pullback. This is the first scenario. Whether you can survive the next small pullback depends on where you put your stop. So if you treat this as the pullback, so most of the traders will put the bottom of this bull bar as the actual stop. So if you put your stop here and then the market goes down, hit your stop, then you are in a losing trade. If it doesn't hit, then that means you can survive the pullback. So this actual stop level could be one of the stop you leverage to survive the pullback. The drawback of leveraging this actual stop is that the market could really go down to test this actual stop and then stop you out, and then it takes off. So you're in a losing trade rather than a profitable trade. To avoid this, other stops we can see is you can at the bottom of this big bull bar, first leg here, so that could be your initial stop. This initial stop gives a very big room for the market to go down and then before it takes off. So the good thing is, yes, you have a higher probability to survive the pullback. The bad thing is you have a large stop here. That means if it hits here, then you have a large loss as well. This initial stop at the bottom actually makes sense, even though it gives large room there, because think about the definition of a trend. For this example, going up, we have a low, we have a high. Next, if it is a higher low and then higher high, that defines the uptrend. So that means if it goes down, as long as it is still above this initial stop, that means it's uptrend. So this initial stop makes sense. This actual stop at the bottom of the pullback is too tight, and then the initial stop at the bottom of the first leg is too much. Is there any other way? Yes. Basically, you can also set the halfway as the stop. The reason that we can have halfway based on the first leg here is because think about the Fibonacci. If the pullback is like 23 or 38, that means the trend is still very strong. But if the market goes down to test 50 or even lower, that means the market is not strong anymore. So this halfway stop makes sense as well. As an experienced trader, whenever you enter the market, you shouldn't be putting your stop here at the pullback right away. At least you need to use halfway stop or even the initial stop here. Let's see what happened next. After this doji bull bar, there's another doji bar, but tail at the top and bottom relatively equal to each other. And then the bottom here, you can see it's going to test your actual stop here, but it didn't even reach it. And then next is a bull bar. This bull bar is a trend bar, and if you didn't enter here with this doji bar, you can enter after this bull bar finishes. At this moment, if you have your initial stop here, or even the halfway stop here, and when you see this bull bar, can you immediately move your stop to the actual stop here? The answer is no, because we're still waiting for the market to really go to the trend direction. This bull bar is not very strong to demonstrate that it's going up already. So we have to wait a little bit more. If you choose this bull bar as the signal bar, basically you can enter the market. Let's see what happened next. Next, there is a big bear bar. The tail at the top pierced the top of the previous signal bull bar. That means if your entry here, you're already in a trade, but immediately it goes down with a big bear bar. This bear bar, you can see it tries to test this actual stop level, but it didn't reach it, it failed. So this is kind of the pullback. You can treat this as the first push, this as the second push, and this as the third push. And then in that way, you really need to survive this pullback. If you put your stop at the bottom of this doji bull bar here, in this example, you already survived. But in some other example, you may not. So it goes down too much, you could hit your stop. And next, we can see there's another bull bar reversing the previous pullback right away. This means the upside strength. And also, this bull bar can serve as another signal bar. If you see this, you want to enter at the top if you didn't before. This is what happened next. So basically, right after you see this bull bar, that means the market takes off. So you can move your initial stop or halfway stop to the bottom of this pullback here. If you are a little bit conservative, instead of putting your stop at the bottom of this pullback, you can also put your stop at the top of the signal bar here, or even here, to make sure you're break even. However, that's another thing that you need to survive. If the market goes down for the third leg here, you have to survive your BE level. Let's take a look at your exit level. If you're using the measured move, you measure from the bottom of the first leg to the top of the last bar of the breakout here, and then measure exactly the same distance from the bottom of the pullback to the upside. You can see that you will exit here. If you're scalping by one time of the risk, and then you choose your signal bar as this bull bar, and then bottom here is the actual stop, so this is your one time of the risk. And we measure up the same distance, then your exit should be around here. If you choose not to exit with this second leg, then you have to survive the swing pullback. This is the second type of pullback for the following pullbacks. So here, the market comes down, you can see a lot, and then especially with this bull bar with a very big tail at the bottom. So this is the swing pullback. If you want to make more profits, or you want to swing the trade, you have to survive this pullback as well. You can clearly see that this pullback even didn't touch the actual stop here. Why? Because if it goes down to touch your actual stop, like I said, the definition of uptrend is low, high, higher low, higher high, and then this one is taking off the actual stop here. That means it's a lower low, so it is not an uptrend anymore. As I mentioned before, some traders are conservative, so they want to move their stop to the BE level to ensure the trade becomes a free trade, they don't lose anything. Let's take a look at their BE levels. If you use this bull bar as your entry bar, then you can see this is your BE level. And here, the market just go down to test this BE level here, but it failed and pushed back right away. However, it could stop you out if you have a BE level here. And then the second BE level is if you use this bull bar as the signal bar to enter the market, you can see it pierced this level as well. The same thing for this bull bar. If you have the entry level at this level, then that means it already pierced even with this bull bar here. So anyways, this is how you want to survive the following pullback. If you rush to put your stop to the BE 1, 2 or 3, you could get stopped. But if you put your stop still at the actual stop, it gives more room, so you may not be a stop out with this big pullback. This is what next the market moves. You can clearly see that the market takes off. It makes another higher high, so it's still in an uptrend. And another thing is that this is the first leg and the second leg. If you want to trade for the third leg or swing, and then you want to add your position, this bull bar is a very good signal bar. You can enter after this bar finishes. So if that's the case, let's do a risk measurement. So measure from the top of the signal bar to the bottom of the signal bar, which is the pullback for the second leg here. Measure the same distance, then you can take a profit here if you choose to add your position. Now let's compare the 3 exits. If we are using measure move, the yellow line here, your exit is here. If you're using 1 time of risk to scalp for the second leg here, your exit is here. If you scalp 1 time of the risk for the third leg, your exit is this level in green. So you can see that it depends on what the chart is, and then these positions could be different. However, the point is here. If you can make enough profit for the second leg, why do you bother the third leg? Let's have a look at another example. There is the breakout of the previous range here. Goes down, and then here's the pullback. This bull bar is the pullback, and you can also serve it as the signal bar, because given the strong breakout to the downside, so this bar has a big tail at the top. Though it is not very good, but you can still use it as the signal bar. If that's the case, here's the top of the pullback. This is your actual stop. And then based on the chart, you can see the market didn't go down right away. Instead, it pulls back again with a small push here, and then this bear bar with the big tail at the top pairs the actual stop here. So if you have a very tight stop, you're gonna get stopped out with a loss. Therefore, again, do not put your stop too tight when you are first in the trade and then the market didn't move yet, to survive the pullback for the second push and the third push. As the market moves, this bar can serve as a signal bar, and then your actual stop is here. Only when you see the market goes down, and then you can move your actual stop here to survive the pullback. In this example, there's only 2 pushes up. 1 bull bar, second bull bar, and then it goes down. Let's have a look at the BE levels for the following pullbacks. If you use this bull bar as the signal bar, your BE level is here. You can see that next the market moves back for the pullback. It tested this bottom of this bull bar. That means if you want to swing, you have to survive this. And also it tested again next here. If you use this as the signal bar, then this is your BE level here as well. You can see that the second small pushback here tested the BE level too. So no matter which way, you have to survive these 2 pushes for the market to go down for the swing. Here's another example. This is the signal bar for you to enter the market, which is the BE level. And then your actual stop is here at the bottom of the pullback. You can see the market for the second pushback or second pullback, it always comes down to test your BE level. So this is why if you want to swing, you have to survive this pullback. But if you scalp, it really depends. So in this situation, it seems that for the second leg up here, it didn't even go up to 1 time of the risk. So if that's the case, you put your BE level as your stop, you're gonna get stopped out. Let's take a look at a real swing example to see how to survive the pullbacks for multiple legs here. Basically, if you choose to enter after this bull bar finishes, this is your first break-even level. Or if you want to see a real bear bar as the pullback, next bar is your signal bar, so you enter here. And your actual stop should be at the bottom of this real pullback here. And then you can see the market goes back to test the entry levels here, but it didn't even reach the actual stop. So when the third leg moves up, what you want to do is to move your actual stop from the bottom of the first pullback to the bottom of the second pullback, and then do the same thing when you see the fourth leg here. You move your actual stop here accordingly, and then this is how you do the swing trade. You can clearly see that each time there's a moving up, the pullback will not touch your previous bottom of the pullback, because this is also an uptrend definition. But if it really goes down to test the actual stop and pierce it, then the setup is over. So that's why for swing trading, you want to exit at the previous bottom of the pullback. Here's another example. When the market goes down, pulls back here and then go down, you can put your actual stop at the top of this bull bar. When it moves down, pulls back again, you move it to the top of this bull bar. And after the market here goes up, you can see you exit at this actual stop level. Is there a better exit in this chart? Seems to be. Let's use the measure move to measure from the top of the breakout bar here. Basically, this is the 9:30 open time, so that's why we do not count the previous small bear bar here. Measure down the same distance, you can see this could be your exit. And then comparing this level with the measure move and this level as your pullback top, you can see that this measure move has a better profit for you. So the drawback to survive the following pullback is that later on the market is not strong anymore, so it could get back a lot to eat your potential profit. But if you use measure move just to take a straightforward profit, you could end up winning more. So this is something that you have to think about for yourself in terms of your strategy. This last example to show you the importance of entering the market as early as possible. So basically, when you see the pullback here with another bull bar, doji bar, and then with a big tail at the bottom, this bar can serve as the signal bar, so you can enter the market. This is your break-even level number 1. And then next bull bar, even though it is very big, you can also enter it, but it is a little bit higher than the first entry level. See how the market works. Later on, this bear bar with a very big tail penetrates the BE level 2, but it didn't even reach BE level 1. You can see that if you measure your stop from the bottom of here to the top of your BE level here, basically you take one time of the profit, you're gonna exit with this bull bar. But if you take the BE level 2, your stop is from here to here, then after the market takes off, it takes a long time to get your one time of your risk. So it could be exit somewhere around this big leg here. So that means if you can enter the market earlier, like in the BE1, you're gonna take less time to make your profit, and then you're out of the market, and then you can shut down your laptop. In another word, how to survive the pullback also depends on your entry level. If you enter early, you can see the market go to test your B level here, and then you can survive this pullback. But if you enter here, you're not gonna survive it. However, later on, you can see the market goes down. It didn't even go to your break-even level here, but instead, it tested the break-even level 2 here. So that means you have a higher probability of getting stopped if you enter late, like in the break-even level 2 here. So the point is enter earlier to have the higher probability to survive the pullback.